the dreaded financial plan. Basically, these are projections of the financial position. Now, if you're a going concern or a business that's already running, you need to include any changes that you propose making. So let's say that you're going to buy a new plant in 3 years. Then in the third year financial statement should recognize either a mortgage or a payment for the actual purchase plant or something like that. Okay, so the first thing we do is we list the assumptions. And these are things like interest rates on loans, inflations, any major changes that are upcoming. Your sales forecasts can go in here as well, or at least be referenced here. Okay, next, if you're a brand new business, you want to discuss your startup costs. How much is it going to cost to start this business? And don't forget to include like 6 or so months of projected operating costs, because you're not going to start being profitable the minute you open your doors. The next are the pro forma financial statements. You do these for a series of 5 years. Now, if you're in a pretty volatile industry, you might want to do the first year quarter by quarter, maybe even month by month. But generally, we do them year by year. In this section, in the plan itself, you do these very abbreviated, very recapped, and the handout shows what one should look like. First comes the income statement, which is basically how much money you make, and it's cumulative. And the balance sheet is a snapshot of pictures and times. It shows the assets, the things that you have, the liabilities, things that you owe, and then your equity, or how much belongs to the owners. And then finally, you want to do a statement of cash flows. And statement of cash flows basically shows where your cash is coming from and where it's going. And then you want to finish up with a break-even analysis. How many do you have to sell, or how many yards do you have to mow, or whatever the case may be, to be able to cover your costs. Then comes the financial analysis. This is how the business looks from a financial point of view. The first thing we need to do is free cash flow. And free cash flow, cash is king, especially with a small business. If you can make all the profit in the world, but if it's being tied up in accounts receivable or whatever, and you can't make payroll, you can't pay your suppliers, then you got a problem. So basically, we want to do a free cash flow. We also want to look at our competitors and industry and do some benchmarking against those. This kind of lets us know where maybe we could do better, or how we're doing in general. If you're a small business, benchmarking against an industry is going to be hard, but you can look at it and say, wow, they only have a gross margin of 15%, we have 18%. Or they have a gross margin of 18 and we have 16. Why is there a difference? Well, maybe it's just because they're so big and they can buy in bulk, and there's nothing you can do about it, but there may be some indications of some things that you can improve. Borrow ideas from the competition or from the industry that seems to be working that you can fit in with your small business. The financial criteria, you want to explain what each of these is and how you stack up against the industry standards or the competitor, or just even the rule of thumbs. The payback analysis, the net present value analysis, the internal rate of return, the modified internal rate of return, and a break-even analysis by product line. So if you sell 6 calculators, then you'll want to know how many of each of those you have to sell. Now, it could be that because of the nature of your business, that not all of these will apply. So if you're a nonprofit, for example, the criteria are going to be different, and we'll have to talk about that. Next, you want to do a sensitivity analysis, which basically looks at your best case, worst case, most likely case scenarios based on the income statement. It's kind of a what-if analysis. And in this section, you want to talk about the 2 or 3 most important income and or expense items that might make a large impact on cash flow. For example, payroll is probably a big expense. So if payroll expense should have to go up because of a change in minimum wage, or if sales drop by 20% or increase by 20%, which of those are going to make the most impact on you? Okay, and then a risk analysis and contingencies. What risks are you going to face, and how can you mitigate them if at all possible? So maybe one of the risks is a recession. How can you deal with a recession? Or another risk might be that somebody else moves into the market. Okay. All right. Finally, the closing section, which deals with what now. We're going to do the action plan, which is basically a Gantt chart, and talks about the major steps that need to be implemented in order to get the business plan going, and make sure that the action plan and the financial statements agree with each other. So if year 3 you say, hire an architect, then your financial statements in year 3 should agree with that. Finally, you want to put in the exit strategy. Mainly you need an exit strategy if you have suppliers of equity capital, in other words, business angels, venture capitalists, bankers, and they want to know how they can get out of this, or what's going to happen if the plan doesn't work. So mostly angels and venture capitals, they want to sell in 5 to 7 years. They want to sell their interest. How do we do that? Are you planning to just close the doors? Are you planning to try to sell out to somebody else? You're going to try to go public. So that's what the exit strategy deals with. And there you go. In a nutshell, how to create a business plan. And as usual, if you have any questions, send me an email.